Australia's June quarter inflation report has dramatically reduced the prospect of another near-term RBA rate hike, bolstering our conviction that the bank's tightening cycle is over. While inflation remains well above acceptable levels, there are clear signs emerging that disinflation is taking place. Headline inflation slowed to 3.9% year-on-year, below the 4.1% pace expected by economists and a long way beneath the 4.8% pace forecast by the RBA back in May. Trimmed mean inflation, the RBA's preferred underlying measure shown on your screen, also undershot expectations, printing at 3.65% compared with market consensus of 3.7% and 3.8% that the RBA was expecting. The overall message is that while inflation remains too high, it is easing faster than both the market and RBA anticipated. When you compare the RBA's May forecast with what actually transpired over the June quarter, every major variable moved in a direction that weakens the case for further policy tightening. It therefore comes as no surprise that markets have dramatically repriced the near-term outlook for rates. The probability of a 25 basis point move in August has collapsed to 2.5%, effectively snuffing out the near-term risk for a hike. However, that does not mean markets believe the tightening cycle is over. Implied pricing still has almost one full hike priced into the curve by the February 2027 meeting, with around a 50% chance of a hike coming through by November. With inflation above target but continuing to moderate, labour market conditions gradually easing and the housing market weakening much faster than the RBA anticipated, which may eventually weigh on household spending through a reduced wealth effect, the hurdle for further tightening now looks materially higher than earlier this month. That should provide a more supportive backdrop for Australian rate futures and, at the margin, domestic equities. Australian 3-year bond futures have rebounded strongly over the past 3 sessions after the contract fell into oversold territory on RSI 14 for the first time since late March. In the process, the price has reclaimed the 50-day simple moving average, which has been an influential level when it comes to determining medium-term directional risk. The next test for bulls comes at 95.62.5 and 95.67, the latter where the price stalled in late June, with the 200-day moving average lurking just overhead. Momentum has also improved. RSI 14 has moved from oversold to marginally above the neutral 50 level, while MACD is converging on the signal line despite remaining in negative territory. Downside momentum has dissipated rapidly, and that may soon be replaced by renewed upside strength. Australian SPI futures have also responded positively, although it's important not to overstate the influence of the less hawkish rate outlook on its performance. It's definitely helped, but it's not the sole factor behind the recent move. A lot of the price action can be explained by the large symmetrical triangle the price had been calling in since the start of March. As highlighted by the red box, there was constant dip buying beneath 8,700 throughout July. After one false break through triangle resistance earlier this month, buyers delivered a powerful breakout through it earlier this week. That was followed by an extension through 8,884 and then the June 18 swing high of 8,976. The latter now becomes the first downside level to watch. Overhead, there was a lot of work done either side of 9070 earlier this year, meaning moves above 9,000 are important both as a test of bullish breakout and whether sellers are prepared to defend the level. A clean break and close above 9070 would point to the potential for a move towards the March record high of 9,187. The oscillators point to building upside momentum, putting bulls in the ascendancy for now.